Every single month, millions of people hand over hundreds of pounds to their bank, not for a service, not for something they chose to buy, but as a penalty, a quietly structured, legally enforced penalty for not understanding exactly how credit cards actually work. And the really maddening part, most of those people think they're being responsible. They're making their minimum payments. They're not missing deadlines. They believe they're managing their credit card just fine. They are not managing it fine. They are being systematically drained. And the bank designed it that way deliberately. Today I'm going to show you exactly how the credit card trap works. Every mechanism, every trick, every piece of deliberately confusing language that makes the trap harder to see. And then I'm going to show you exactly how to get out and how to use credit cards in a way that actually works for you instead of against you. This is the video the banks don't want you to watch. Let's go. Let me start with the most effective wealth-destroying mechanism ever invented for ordinary people, the minimum payment. Here's how it works. You spend on your credit card. The balance builds up. At the end of the month, your statement arrives, and at the bottom in clear, friendly numbers, it tells you the minimum payment required, usually somewhere between 2 and 3% of the outstanding balance, or a fixed amount like £25, whichever is higher. That number is designed to feel manageable, reasonable, almost generous. Look how little you have to pay this month. But here's what that minimum payment actually costs you. And I want you to really sit with these numbers because they're genuinely shocking. Let's say you have a credit card balance of £3,000 at a typical interest rate of 22% APR. If you make only the minimum payment every month, which is what the bank is explicitly inviting you to do, here's what happens. It will take you approximately 27 years to pay off that balance, and you will pay nearly £5,000 in interest alone on a £3,000 balance. You will pay the bank almost double what you originally spent, and it will take nearly 3 decades. 27 years, £5,000 in interest for a £3,000 balance. Read that again if you need to, because that is not an extreme example. That is the mathematically precise outcome of doing exactly what the bank's minimum payment structure invites you to do. The minimum payment is not designed to help you pay off your debt. It is designed to keep you in debt as long as possible while extracting maximum interest. It is, quite literally, the most profitable thing your bank can get you to do. Trap number 2, and this one is built on deliberately confusing language. When banks advertise credit cards, they often quote 2 different interest rates. The purchase rate applied to everyday spending, and a different, often higher rate applied to cash withdrawals. But here's the confusion that costs people money. The APR annual percentage rate that's advertised is the rate that applies when you carry a balance on purchases. What most people don't realize is that there are several situations where much higher rates apply automatically, often without any clear warning in the moment you're spending. Cash withdrawals on a credit card typically attract a fee immediately, usually around 3% of the withdrawal, plus a higher interest rate that starts accumulating from the day of the withdrawal, not from your statement date, from day one. There is no grace period for cash advances. Balance transfers move in debt from one card to another, often advertise attractive promotional rates. 0% for 12 months sounds incredible, but the small print typically includes a transfer fee of around 3%, an expiry date after which the full standard rate kicks in. And critically, the information that new purchases on a balance transfer card may attract the full rate immediately while your payments are applied to the promotional balance first. These are not accidents. They are structural features that maximize the likelihood of customers paying more interest than they expected to. The fix is simple, but requires real attention. Before you use a credit card for anything other than standard purchases, read what rate applies. For cash withdrawals, never use a credit card as a cash machine unless you're in a genuine emergency and understand the true cost. For balance transfers, read every word of the terms before you apply. Trap number 3. And this is the one that surprises people most because it's not about interest rates or fees. It's about how credit cards change the way your brain processes spending. There is a well-documented psychological phenomenon that happens when you pay with card versus cash. When you hand over physical cash, your brain registers the loss immediately and viscerally. You feel it. The transaction has a psychological weight. When you tap a card, especially a credit card, where the payment is deferred to a future date, that psychological weight is significantly reduced. Multiple studies have shown that people consistently spend more when paying by card than when paying with cash for identical purchases. The friction of payment is lower, the pain of loss is delayed, and spending feels less real in the moment. Credit cards amplify this effect because the payment is not just frictionless, it's genuinely deferred. You're not spending money you have today, you're spending money your future self will have to deal with. And human psychology is remarkably good at ignoring future consequences in favor of present comfort. Banks understand this perfectly. It's why credit cards are designed to be as frictionless as possible. Contactless payments, one-click online shopping, automatic payment setup that means you never even have to actively engage with the card to use it. The result is that most people genuinely spend more with credit cards than they would with cash or debit, often significantly more without realizing it's happening. And that additional spending becomes additional balance, which becomes additional interest. Here's what I do to combat this in my own life. I track credit card spending in real time, not at the end of the month when the statement arrives, but throughout the month, treating every credit card purchase as if it's coming out of my bank account today, not at the end of the month. Because that's the mental model that keeps spending honest. Trap number 4. This one is going to upset some people, but it needs to be said. Credit card rewards cash back, air miles, points, whatever form they take, are almost universally a bad deal for people who carry any balance whatsoever. Here's the maths that banks count on you not doing. A typical cashback credit card offers around 1% cashback on spending. So for every £100 you spend, you get £1 back. Sounds great, feels like free money. But the average credit card interest rate is around 22% APR. If you carry even a small balance, even £50 from month to month, the interest you pay in a year dwarfs the cashback you earn by a factor of 10. 20 more the rewards are designed to do one specific thing. Make you feel positive about your credit card. Make you feel like it's working for you. Make you less likely to pay it off aggressively because, well, it's a rewards card. It's actually beneficial to use it, right? Wrong. For anyone who carries a balance, the rewards card is not beneficial. It is a very effective psychological tool that keeps you engaged with a product that is costing you far more than you're getting back. Now, here's the honest exception. If you pay your credit card balance in full every single month, without exception, a rewards card can be genuinely beneficial. You get the cash back or points. You pay zero interest. The card is functionally being used as a debit card with benefits, but the operative phrase is in full every single month without exception. The moment you carry a balance, even once the interest wipes out the rewards and then some. If you're not certain you can pay in full every month, a rewards card is not for you right now. Pay off the balance first. Build the habit of full monthly payment. Then consider rewards. Right, enough about the trap. Let's talk about getting out of it. If you're carrying credit card debt right now, here is the exact sequence I'd follow. Step 1, stop adding to the balance. This sounds obvious, but the single most important thing you can do when you're in credit card debt is to stop the bleeding. Cut up the card if you need to. Remove it from your saved payment details online. Do whatever it takes to break the habit of adding to a balance you're trying to pay down. You cannot fill a bucket and empty it simultaneously. Stop filling it first. Step 2, list every credit card balance, rate, and minimum payment. Get everything on paper. The total balance, the interest rate, the minimum monthly payment. Most people have a vague, uncomfortable awareness of their credit card debt without ever looking at the full picture at once. Look at it. The discomfort of seeing it clearly is temporary. The cost of continuing to avoid it is not. Step 3, apply the avalanche method. List your cards by interest rate highest to lowest. Every pound you can free up above the minimum payments goes to the highest rate card first. Pay minimums on everything else. When the highest rate card is cleared, roll that entire payment toward the next highest rate. Repeat until everything is gone. This is mathematically the fastest, cheapest way out of credit card debt. The interest savings compared to making equal payments across all cards can be genuinely significant. Step 4. Don't close the accounts immediately. Counterintuitive, but closing paid off credit card accounts can actually damage your credit score in the short term because it reduces your available credit and changes your credit utilization ratio. Once a card is paid off, put it somewhere inconvenient rather than closing it immediately. Use it for one small regular purchase, paid off automatically in full each month to keep the account active without accumulating debt. Step 5. Build the emergency fund simultaneously. I know you want to put every penny toward the debt, but without even a small emergency buffer, the first unexpected expense sends you straight back to the credit card. Build a 1-month buffer even while paying down debt. It protects your progress. Now here's the part most financial content skips. Credit cards are not inherently evil. Used correctly, they are genuinely useful financial tools. The trap is not the card, it's the behavior. Here's exactly how I use credit cards now. Rule 1. Every balance paid in full every month, without exception. I treat the credit card like a debit card. I only spend what I already have in my bank account. The credit card is just a mechanism of payment, not a source of additional funds. Rule 2. One card for everyday spending. One card kept for emergencies, not two active spending cards. Simplicity reduces the chance of something slipping through unnoticed. Rule 3. Spending tracked in real time. I review my credit card transactions weekly, not monthly, when the statement arrives. Weekly, this means nothing accumulates into a surprise at the end of the month. Rule 4. Automatic full payment set up. I have a direct debit set up to pay the full statement balance automatically every month. I don't have to remember to pay. I don't have to make a decision. It happens automatically. This single setup removes the most common and most expensive credit card mistake, forgetting to pay or choosing to only pay the minimum. Rule 5. The rewards are a bonus, not a reason to spend. I have a cashback card that earns 1% on spending. That cashback is a bonus on spending I was going to do anyway. It is never a reason to spend more than I would otherwise. Use this way with full monthly payment, real-time tracking, and automatic settlement. A credit card is a safe, useful, mildly rewarding payment tool. Use the way the bank hopes you'll use it, carrying a balance, making minimum payments, accumulating interest year after year. It is one of the most effective wealth destroyers available to ordinary people. The card is neutral. The behavior determines the outcome. The credit card trap is not complicated, but it is deliberately designed to be difficult to see clearly because clarity is not in the bank's interest. The minimum payment that keeps you in debt for 27 years. The interest rate confusion that catches people on cash withdrawals and balance transfers, the psychological effect that makes you spend more without realizing, the rewards that feel like benefits but mask a product that's costing you far more than you're getting back. Now you can see it clearly, and you can't unsee it. If you're carrying credit card debt right now, the steps are in this video. Start with step 1. Stop adding to the balance today, right now. If you're credit card debt free, keep it that way. Use the card as a tool. Pay in full every month, and never let the minimum payment feel like a reasonable option. The banks are very good at what they do, but so are you when you know what you're dealing with. If this video opened your eyes to something important, subscribe to this channel. Every week I put out honest, practical financial content that actually helps you keep more of your own money. Drop a comment below. Have you ever calculated how long your minimum payments would take to clear your balance? Do it now if you haven't. The number will shock you. Tell me what you find. I'll see you in the next one.